My name is Mike Binger, President of Gradient Investments. It is my privilege to introduce the Gradient Investments Buffered Index Portfolio. This portfolio is designed for investors to participate in market growth, but also offers a predetermined level of downside protection. The Buffered Index Portfolio will invest in a series of structured notes that offer a predetermined set of terms. These terms include the cap, which sets the level of maximum upside participation, and the buffer, which is the predetermined level of downside protection. The structured notes in the portfolio are issued and backed by the credit of investment-grade underwriters, which are some of the largest financial institutions in the world. They are also linked to a price return of a specific index. They are issued with a fixed maturity date. And finally, they are not actively traded on security exchanges. To select the notes for the Buffered Index portfolio, Gradient will determine the following terms. Number one, we will determine the index that will be used. Secondly, we will select the level of protection or the buffer. Thirdly, we will select the time to maturity for the note. And finally, we'll select the level of participation relative to the index, known as the participation rate. After setting these terms, the investment team at Gradient will solicit multiple bids from investment-grade underwriters that offer the maximum level of upside participation, or the cap, based on these predefined terms. Cap rates can vary based on terms provided, as well as market factors, such as volatility of the index used and current interest rates. Let's discuss a hypothetical scenario with the following terms. Gradient Investments selects the S&P 500 as the index. We establish a 10% downside protection buffer and a participation rate of 100% on the index. Finally, we select an outcome period of 366 days. With these terms, the underwriter sets a 12% cap or maximum upside return. In this scenario, if the note is held to maturity, we could expect the following to occur at the maturity date. If the S&P 500 price return is up 5%, the performance of the note will return 5%. If the S&P 500 price return is down 5%, the performance of the note will be 0 or flat because of the buffer. Under more extreme situations, if markets are very strong, with the S&P 500 price return up 20%, the note will be up 12%. This is due to the capped upside participation that was predetermined in the note. If markets fall aggressively and the S&P 500 price return is down 20%, the note will be down 10%. This is due to the buffer protection of 10%. But then the note participates 1-for-1 in the remaining decline. As you can see, it is possible to lose money in a structured note. The note does protect against a certain level of loss, the buffer, but can participate in losses below the predetermined buffer level. Important considerations for the Buffered Index portfolio are liquidity and intra-period returns. Because structured notes are designed as a point-to-point solution, we encourage investors to remain invested to the maturity date to achieve the predetermined outcomes. However, structured notes are priced daily at a net asset value, or NAV, and can be redeemed intra-period if necessary. We would note that intra-period liquidations may not directly correlate with the price return of the index and are subject to a 25 basis point or 0.25% reduction to net asset value on the liquidation date. If assets are held to maturity, the note will liquidate and proceeds will go to cash. Once the note is liquidated, investors can then choose to use proceeds for the next structured note offering. Importantly, proceeds from a matured note will not be automatically invested in the next offering, as terms and market conditions are subject to change. In summary, the Gradient Investments Buffered Index portfolio uses structured notes to provide investors with a predetermined buffer of downside protection, along with upside participation to a maximum cap rate. This structure will allow investors to take advantage of market growth, but also provide some protection from market downturns. Gradient will define the terms and solicit multiple bids to select attractive cap rates that are backed by investment-grade financial institutions. These notes are meant to be point-to-point solutions, but do offer daily pricing and liquidity if necessary.